Welcome everybody, it's Private Profits Trading and we have another class today. Real quick, we want to breeze over a few slides and make sure everybody is at a unison and understanding what exactly it is that is going on with the market right now. So just tune in with us. Hope you stay until the end. A lot of information will be dissected today and hopefully it'll help you a little bit. Okay. So let's go over a little bit of basic stock market terminology. So stocks are the capital raised by a business or corporation through the issue and subscription of shares. Shares are pieces of the company that you own outright with no expiration. Buying shares makes you a shareholder. All right, so the difference between bulls and bears. You're going to hear that a lot during your stay in the stock market. So bulls strike up and bears strike down. Just a quick way to think about it. Bulls strike up, bears strike down. So the bull market is when the stock market as a whole is in a prolonged period of increased stock prices, uptrend. And a bear market is when the stock market is in a prolonged period of decreased prices in a downward trend. So right now we're in a bear market. We're on a downward trend. Widely used terms. So you have trade, when a buyer sells a stock. Day trade, buying and selling a stock within the same day. Swing trade, holding a stock overnight or longer. Going long, bullish on a stock thinking it's going up. Short, bearish on a stock thinking it's going down. Volume, the number of shares of stock traded during a particular time period, normally measured in average daily trading volume. Call, an option trade that seeks the stock's prices to go up. Put, an option trade seeking the price to go down. Shares, pieces of the company you own outright with no expiration date. Dividends, a portion of a company's earnings that is paid to shareholders, people that own the stock, on a quarterly or annual basis. Not all companies pay dividends. Scalp, quick day trade. Take profits to sell your position. High of the day, the highest price of the day. Low of the day, lowest price of the day. FOMO, fear of missing out. Technical analysis, price trend, candlestick pattern, supply and demand, support and resistance indicators, VWAP, RSI, and the MACD, and a bunch of other ones. And then you have fundamental analysis, fair pricing, earnings reports, economic conditions, industry analysts, long-term trading. So expectations. Will you become rich the day after you take private profits trading? No. Will you still need to put in work on a constant basis? Yes. Will you learn a lot and build a foundation to becoming a successful trader? Yes. Our goal is to give you a foundation to becoming a successful trader, whether you are a beginner or have been trading 2 years, Quick basics. Trading less is more. Focus on the big picture. Start small and build your way up, no matter the account size. Every trade should have a plan with an action. So cash versus margin account. So a cash account does not have a restriction on how many day trades you can make. You can trade the funds available in your account until they are no longer available. Shares take 3 days to settle, while options settle overnight. After the cash is settled, you may trade with those funds again. Example, if your account has $1,000 in it and you buy an Apple call worth $300, you now have $700 to trade with for the rest of the day. The next morning, the profits or loss you took on the 300 Apple call will be ready to use again. Margin accounts under 25,000 are restricted to 3-day trades within a 5-day period. Over 25,000, you have unlimited day trades. Margin accounts have allowed you to borrow money in order to leverage positions. So for example, TD Ameritrade has 4 times margin on equity or shares. So if my account balance is 25,000, I can enter into 100,000 equity or stock positions on margin. So let's just go over a few brokerages. TD Ameritrade. This is very popularly used by retail traders. It allows cash and margin accounts. It's an amazing platform and interface free with account. Mobile app is easy to use, zero commission fee for stocks. I love Thinkorswim. The custom code, VWAP code that we have, the multi-day VWAP, is for Thinkorswim, which will be hosted by TD Ameritrade. Love to use this for charting. Take a look. This is what it looks like on a laptop. As you can see, we have the Ishimoku cloud in there, the average true range, RSI at the bottom. All right, Webull. Love Webull. Webull is super interface friendly. The visual rhetoric is there. Super quick. If you're on mobile, it gives you good data for your mobile. I like to execute all my trades through Webull. I like to be fast when I'm executing trade, make sure my orders get filled. So definitely recommend Webull on the mobile app. Fidelity. I'm not a big fan of holding stocks, but Fidelity is my go-to for holding anything. I love the platform, good customer service, a lot of data, a lot of information, educational tools. They do have Active Trader Pro, I believe, which is a good tool to use on desktop. If you are interested in Fidelity, I'll definitely take a look at them. They're awesome. All right, so the summary of a fundamental analysis. The stock market analysis of breaking down a company's financial information to find intrinsic value versus market value. It requires an in-depth study on a company's past performance, present performance, and future expectations. Yahoo Finance provides a great rundown on every company's financials and balance sheet. So this is a company's income statement. As you can see, we have the breakdown of total revenue, the cost of revenue, gross profit. So this will give you a good indication on where a company's headed, if they're making money, if they're not, if they have a lot of debt. Gives you a good roadmap. Like I said, I don't like holding stocks, but if you do like to invest in the stock market, you definitely want to be taking a look at the company's fundamental analysis of their income statements, balance sheets, cash flow. All right. So here's an introduction to options trading. We're going to go over a few things with options. Financial instruments, what are options, characteristics of an options contract, different types of options, writing options, and why do we trade options. So financial instruments, they are a means to an end. To make music, you need a musical instrument. To watch a TV, you need a TV. To watch a movie, you need a TV. Similarly, to transact in a financial market, you need a financial instrument. A financial instrument is nothing but a financial contract between interested parties. They can be created, traded, modified, and settled. In a nutshell, financial instruments are means to exchange money in the market. Financial instruments can be either cash instruments or derivative instruments. Cash instruments are those that the markets value directly. Example, stocks are considered cash instruments. Derivative instruments are those that derive their value from movements of an underlying entity, such as a stock or bond. An example is an option, future contract, etc. So you have cash instrument like stocks or cash, equities, and then you have those that derive from those instruments, such as options or contracts. So what are options? Options is a derivative instrument that specifies a contract between two parties for a future transaction on an asset at a set price within a specific date. All right, so what is an option contract? An option is a contract that gives the buyer the right but not obligation to buy or sell the underlying asset or security at the agreed price within the agreed time. So what are some key takeaways? The option contract buyer pays for the right to complete the transaction. but is under no obligation to do so. Hence the term option. It's like wholesaling properties. You get the house under contract, sign a purchase agreement, and you have the right, well, an equitable interest in that property, and then you can go on to sell that contract for more. So it's agreed price, which the price of the option buyer can buy or sell the underlying security, which is the option strike price, and agreed time. This is the expiration date of the option, and the option buyer has the right to exercise their option by this date. So what are some of the characteristics of a stock option contract? So you have the strike price. All stock option contracts can be associated with the strike price. This is the price at which the option holder can either buy or sell the underlying security, depending on type of option contracts. You have the contract size. This refers to the fixed unit of shares that each option contract holds. The contract size for a stock option contract is standardized at 100 shares. So for each option contract, the option buyer reserves the right to buy or sell 100 shares of the underlying security at the strike price by the expiration date. Stock option contract sizes are defined by the option exchanges. All right, continued. You have the option premium. Option premium is the price you must pay to purchase an option contract. Option premiums are quoted on a per share basis. Example, the option premium needs to be multiplied by 100. So for example, let's assume the premium for Apple 120 call option is $2.25. So the buyer will have to pay $2.25 times 100, equaling $225 per option contract. So the expiration date. This is the day the option contract expires. Most stock options have weekly, monthly, and quarterly expiration dates. On option expiration, option owners will have the following choices. Sell the option contract to another buyer on the market, realizing profit or loss. Exercise the option contract to purchase shares of the underlying security, realizing profit or loss. Or let the option contract expire worthless. Note, U.S. stock options can be exercised anytime before expiration. The break-even price. So our strategy here at Private Profits, we aren't really concerned too much about the break-even price because we do not like to hold stock options, right? We're just in and out. We're looking for the momentum to take us to where we need to get. So our prices don't need to necessarily get to the break-even price to be in the profit. But the break-even price is the price level the stock must break above, call options or below if it's a put option, by expiration for the option holder to realize profits. At option expiration, let's say AMD is trading at $43 and you decided to exercise your contract to buy 100 shares of AMD at average price of 42 per share. So your position will be 43 minus 42 equals 100 in profit at current market value. But the premium you paid for the option contract is first place is $100. So net profit loss equals profit minus premium. 100 minus 100 equals 0. To break even, the stock price must be break even price 43. To realize profits, the stock must break above BEP at expiration. BEP is only relevant if you intend to exercise the option. As option traders, we will exit our position for gain loss before options expiration. So we are trying to realize gain or loss before the expiration, so break even does not really apply to us. So types of options. two types of options available. You have the call and put option. So call option gives the buyer the right, not obligation, to buy shares of the underlying security at the strike price specified in the option contract. Investors buy call options if they believe the stock price will rise by a certain amount by expiration date. Investors will be able to secure profits by selling the option contract if the stock price moves in their favor. Investors will also have the right to exercise the call option and buy shares of the underlying security at the strike price specified in the option contract. So call options are pretty much if you believe that the stock price is going up. So let's say you bought pins at $20 weekly call option at $2 when pins was trading at 20 per share. Okay. When you buy a call option, you stand to make money if the stock price rises. As an options trader, you will start seeing profits as soon as the stock price starts moving in your favor. You can sell your contracts and secure profits at given time. For exercising the option contract, the break-even price is $22. At expiration, if pins is trading at 24, you stand to profit $200. So if we look at this graph right here, we see the stock price is 20. To the left of us is all we risk. That's our max loss, everything you risked. So you paid $2 for a call option, which is an equal of $200 since we have to multiply that times 100. So your max loss is $200 and your gain is infinite, really, just depending how much that stock price. So the more that it moves, continues to move up, you begin to realize your profits. All right. So a put option gives the buyer the right, not obligation, to sell shares of the underlying security at the strike price specified in the option contract. Investors buy put options if they believe the stock price will fall by a certain amount by the expiration date. Investors will be able to profit by selling the option contract if the stock price moves in their favor. Investors will also have the option to exercise the put option and sell shares of the underlying security at the strike price specified in the option contract. Both call and put options are available as stock options, index options, future options, currency options. So here we have another example. Let's say you bought Uber $40 weekly put options at $3 when Uber was trading at 40 per share. So when you buy a put option, you stand to make money if the stock price falls. As an options trader, you will start seeing profits as soon as the stock price starts moving in your favor. You can sell your contracts and secure profits at given time. For exercising the option contract, break-even price is $37. At expiration, if Uber is trading at 34, so you stand to profit $300. So you can see we have a buy here, $40 is the stock price. Max loss of $300 since we bought it for $3. Times 100, right, is 300. And then to the left of us, as we continue to move down, we get more into the money. So the more it moves into our favor, if we bought we bought the 40 weekly, okay, so it would get to 37 before we could break even, but that's just the exercise. The more it starts moving in our favor, the more we're getting paid. So we're just looking forward to move in that direction. So in the money and at the money. So in the money options, call options is considered ITM if the current stock price is higher than the strike price. And put options, a put option is considered in the money if the current stock price is less than the strike price. So on the left you see the calls, on the right you see the puts. So it is in the money if the price of the stock, let's say this is Baidu, is $105 a share right now. So everything that is less than 105 is in the money, which is, you see in the middle, 104, 103, 102, 101, 100, all the way down is in the money. And the same thing on the put side, everything that is higher than the current price of 105, which is 106, 107, 108. So that is in the money. At the money, a call or put option is considered an ATM if the stock price is the same as the option strike price. So you would be at the money to get in the money. And out of the money options, a call option is considered OTM if current stock prices are less than the strike price. And the same for put options. So if it's 105 now, out of the money would be anything on a call option that is greater or less than. Let's see. Call options 106, 107, 108. This is out of the money. Out of the money. In the money would be anything under 105. And the same for the put. Anything that is over will be out of the money. Out of the money. You still can't make money buying out of the money call or put options. It's a little bit more advanced. You want to know your prices, your Greeks. But we'll get into Greeks and deltas, thetas, vegas, rho. We'll do all that later. Right now, it's just a brief synopsis of quick terms to know, quick breeze through call and put options and how to profit for them. So what we necessarily do is we buy call options in the money, at the money, or out of the money. So let's just say, for instance, I bought it out of the money. Let's say Baidu was 105. I'm looking at the 110. I'm looking at average true range. I see it moves, and this is hypothetical speaking. I see it moves $5 on any given day. All right, I see it moving to the upside. I buy the 110 call option. It might be worth, let's see, 78 cents. It goes from 78 cents up to $1.25. I'm making money, and it might not even have went all the way to $1.10. Probably stopped at 107, but the momentum is taking me. Implied volatility is taking it to, allowing the prices of that contract to change. So you're just looking for the price of the contract to start becoming profitable in order for you to start making money. And same thing with the put option. You're just buying a contract, hoping the contract increases in value based on the direction that the stock price is moving. And we'll get more into that, but I hope this helped. If you have any questions, I don't want to really make any too many long videos. Just want to kind of break everything up into different sections so we can get an understanding of what's going on. Any questions about in the money, out of the money, put options, call options, please email me support@privateprofitstrading.com, or drop a question in the Discord if you're in there, or the Facebook group. Happy trading, everybody. See you guys next time. Take care.